Oftentimes people think, well, Medicare just cover my nursing home. Does it, man?
No, it
Thank
won't.
you for that, man.
Hello and welcome to the Mach 1 Market Moment, where we provide financial information on topics such as investing, insurance, financial planning, and everything related to your money. A quick reminder that the hosts of the show are employees of Mach 1 Financial Group. This podcast is for informational purposes only, and nothing said in the show should be taken as investment advice. Employees and clients of Mach 1 Financial Group may maintain positions in the securities or strategies discussed. We upload a brand new podcast every Thursday, so be sure to subscribe to our show so you never miss an episode. Also, follow us on all of our social media platforms. We are Mach 1 Financial Group on Twitter, Facebook, LinkedIn, and YouTube.
Hey guys, today we're going to do a book giveaway. We're going to give away a book by Chris Hogan called Retire Inspired to the first 3 people who go to our website and under the podcast tab submit a question to the podcast. We'd love to take your guys' questions and answer those in the upcoming podcast. So for the first 3 people that submit that, we will reach out, get your contact information, and send you a book. Again, it's by Chris Hogan, national bestseller called Retire Inspired.
Hello, this is Mike Frost, and we're here on episode 64. And today on the podcast, we're going to be discussing long-term care, something everybody is just dying to hear about. That's a pun there, folks. Okay, David, Matt, we're talking about long-term care. I'm the closest one to it that's going to need it. So I really need to know this stuff, so I'm hoping you guys can provide us some good information. All right, so what is long-term care? David, what is it?
In my opinion, from my viewpoint, it's really an asset preservation tool. What it's truly designed to do is obviously cover the cost or most of the cost of going into a long-term care facility, typically like a nursing home. There are products today that will cover home health care as well, but traditionally it's used to cover most of the cost of what it would cost you if you had to go into a nursing home facility. And the reason why, and maybe Matt, you can chime in here, but the reason why I talk about it being mainly an asset preservation tool is because if you don't have long-term care and you go into a facility, and then ultimately you're having to pay for the cost of long-term care out of your own pocket, typically out of your retirement assets, which dwindles those assets, and so they'll be less available at death for the next generation.
Well, let's address a common misconception. So let's say you're 65, you're on Medicare, and you go into a nursing home. Oftentimes people think, well, Medicare just cover my nursing home. Does it, man?
No, it
Thank
won't.
you for that, man.
No, Medicare, and it gets in, there's a lot of details and specifics. I think it'll cover up to 100 days. So pretty short period of time, but that's all Medicare. So I would look at Medicare's, don't view that as a long-term care policy or anything at all, even if it does chip in a little bit at the beginning.
So if you're listening to this and you think Medicare is going to cover your nursing home care, it will not. It will just a very short period of time, and you have to have a hospital stay of up to 3 days before that, before it'll even cover that 100 days.
Now, Medicaid, on the other hand, will cover long-term care, but not until you're basically broke and out of money.
Right.
And that's where you came from. It's long-term care is an asset protection tool. If you have no assets and you go into a nursing home, Medicaid will kick in based off some parameters, and you'll get coverage. So you're going to get coverage one way or the other. But if you have a significant amount of assets and you don't want to spend them down to qualify for Medicaid, then you need to listen to this podcast and understand about long-term care.
Yeah, that's exactly right. And one of the things I always like to start with is reminding people that long-term care insurance is just like any other insurance. You're just trying to offload the risk of something that you're concerned about or don't want to bear yourself to an insurance company. So if someone comes in and they say, Matt, I don't care if I leave any money to my kids, or I don't have any kids, or I want to spend down everything I have. It doesn't bother me at all to rely on Medicaid to cover nursing home, end of life situations and all. Then you just answered your own question. You don't need long-term care insurance. The risks or your concerns, don't justify needing to go out and try to offload risk to an insurance company. So those are the first things, is like starting with, what are you most concerned about? What risks are you not comfortable completely having on your shoulders and yours alone? And then have a conversation around, Now, how can we look at implementing long-term care to maybe offload some of that risk? And that sounds oversimplified, but it really does need to start there, because oftentimes I'll have conversations and we get to the conclusion that you don't need long-term care insurance.
That's right.
And that is part of our retirement flight plan, is to ask these questions. So when you're a client or you come in, you talk to any of us, you are going to get that kind of conversation.
Yeah, in fact, to your point, Mike, on the Retirement Analyzer, there's even a tab called long-term care planning. So we can actually project out for someone what the future might look like if one spouse or the other or both had to go into a long-term care facility. And oftentimes that's a good way of helping people decide, to your point, Matt, whether, what your objectives are, and whether you're maybe even self-insured possibly. There are a few people who have plenty of money to where they're self-insured. There's a lot of people who fall in the category where they don't, frankly, have enough assets to are large enough to have to protect with long-term care policy. But there are quite a few people in that middle ground where they've got enough assets where they should protect it with the long-term care policy, but not quite enough assets where they're self-insured and they can easily handle that risk on their own.
Right.
So Matt, you're our insurance expert. How long do I need to have long-term care insurance for? Do I need the rest of my life, like whole life insurance, or how long?
Again, it goes back to that initial conversation of what are your biggest concerns, because every situation is different. And I typically tell people we need to start with looking in terms of calculating how much you need, like what keeps you up at night, what are you afraid of, or what's really concerning, what's your family history look like. For those of individuals who aren't opposed to doing some additional planning with an attorney, right, doing some advanced Medicaid trust planning. We're not going to get into a lot of that today, but for those people that are willing to do that, the maximum you would need is 5 years worth of coverage, because after that, then some of that advanced planning with the trusts that you've done with the estate planning, Medicaid planning attorneys, that will then begin to kick in. Now, I've had conversations with clients who don't want to do that, or they don't have someone they trust to set up the trust like it needs to be set up and hand over the assets and all of those kinds of complications that can come with that. So I've had people who say, I want it as long as I can buy it. Maybe it is a lifetime policy. But for a lot of people, like David was saying, kind of that middle cohort of people that where a lot of people fall that do need long-term care, 3 to 5 years is kind of my sweet spot. 3 years is probably going to cover, help you preserve a lot of your assets, and then anything beyond 5 years, if you're doing the trust planning, is not necessary.
Yeah, three to 5 years is a good rule of thumb. In fact, I can't quote the statistic, but I've read statistics before where I think the average age or the average lifespan of someone once they go into a facility is like 2 years.
Right. Yeah, and that's another thing to keep in mind is, like, if your only concern is, if you're not worried at all about a longer term stay, right, again, then why would we try to offload risk of that to an insurance company if all we're worried about is, hey, the last year or two? That's all we're really wanting to protect. Well, then buy a policy that covers, a year or two.
Right.
About 3 to 5 years is what I heard. And Matt, I think you're referencing the Medicaid 5-year look-back rule.
Yes, sir.
So if you want to get more details on that, we can go deep in that. But hear this. Some of you may be thinking, well, if I go into a nursing home, I'll just put all my assets in someone else's name, and then they'll be okay, and they won't be able to get, well, Medicaid will go back 5 years and look at anything you've done financially. Put a house in someone's name, gave away a bunch of money, and they can undo that or not pay for your care for however long that would have covered. So you don't want to do that. I have a really bad example where a friend of ours did that, put their house in their child's name, and the child was married. The child's spouse decided they didn't want to be married, and so they had to sell mom and dad's house to give ex-spouse half of it. And here they were doing it to protect their house, and now they didn't have a place to live. So be careful about doing things like that. Come in and talk to a fiduciary financial advisor, and let's see if you actually need long-term care. Okay, Matt, so what situations does long-term care cover? I mean, is it a broken arm? What is it?
Typically, most policies will pay benefits when you've met two certain kind of situations. One of them being the not being able to perform 2 of the 6 activities of daily living,
commonly known as ADLs.
Right. So that's not to go through all 6 of them, but like toileting, eating, cleaning, bathing, whatever, just basic daily activities. And then the other one is typically defined as a severe cognitive impairment. That one's a little bit harder to kind of define, but most of the time, it takes one, sometimes two physicians signing off on the fact that, yes, this person has a severe cognitive impairment and needs help, on a day-to-day basis.
So if you meet those criteria, then there may be a elimination period, commonly like a deductible, maybe 30, 60, 90 days. And then they start paying off. Different policies do it different ways. So how do people get reimbursed? Do they just write them a check? Do they write it to the nursing home? How does that work?
Well, there's, again, different types of policies. Some will pay direct and pay you on the front end, just like send you a monthly amount regardless of what your expense is. A lot of them, though, are on the reimbursement side. And so you would have the expenses, submit the receipts, and then they'll reimburse you on a monthly basis for those expenses. So on that note, there's two main types of policies. The way I classify them, this is not a long-term care textbook definition, but is your traditional long-term care policies and then your hybrid policies. Your traditional is the use it or lose it. I compare it to your auto insurance. You pay a set annual premium that can and most likely will change in the future after a set date, but you either need the insurance at a later date or you don't, and if you don't use it, then you've paid these premiums for insurance that you don't end up needing. That can be absolutely appropriate in very specific situations. However, with as expensive as long-term care has gotten, long-term care insurance, long-term care insurance, the hybrid policies have become a lot more attractive because they offer different benefits and pay out for different reasons. If you don't use it, there's like a death benefit at the end because it's kind of wrapping in a life insurance policy. So it's not a all for naught if you don't end up needing long-term care. It can be a little bit more expensive, but the premiums are also guaranteed, so they're not going to change on you. There's a lot of advantages to the hybrid policies, in my opinion, but those are the two differences. And so when you're looking at what they'll pay out for, how much they'll pay out for, how long, there's a bunch of different variations within the traditional long-term care insurance, but then you also have the hybrid long-term care and all of the different variations and the ways policies can be structured there. So a lot of different options. Definitely, do your homework and talk to somebody who really understands this stuff, because there are pros and cons to both. A lot of people were sold long-term care policies a decade or so ago thinking the premiums were fixed, and they may have been for 10 or 15 years, but there are essentially no policies that I'm aware of on the traditional side that have fixed premiums. They almost all at a certain point within the policy have the ability to start adjusting them. Some have really good track records of not doing so, and then I've seen other policies where consecutive years they've seen 70% premium increases in back-to-back years.
And they see those increases just about the time when they're 70, 75, 80 years old, and the potential of them needing that care is the greatest, and then they can't afford it because the premiums have gone up.
They can't afford it. And the one thing that people get confused about, it doesn't mean just because you can't pay that new premium does not necessarily mean the policy lapses, but you're going to have to take advantage of one of the non-forfeiture options, which means your amount of coverage is going to go way, way down. The amount of time it pays out is going to go way, way down. And so you're stuck in this predicament of, okay, do I cut my insurance and make it drop dramatically, or do I pay this ever increasing premium? It's a tough spot to be in later in life.
This is one of the reasons why I'm, and maybe you can expound on this a little more, Matt, but one of the reasons why I'm such an advocate of what you call the hybrid policies, where the life insurance, it has a life insurance death benefit. So if you don't end up needing it, your family is still going to get the money via the death benefit, tax-free, by the way, or you get long-term care benefits typically via an accelerated death benefit rider.
Right. Yep.
And again, the reason why we like that is because of a lot of the reasons you just indicated right there, Matt, that, once you get to the point where you're getting to the age where you might start needing these traditional long-term care policies, we see the premiums starting to go up, and a lot of people end up making the decision, I'll just let it lapse. And that's one of the ways insurance companies make money on these policies.
Yeah, absolutely.
And the neat thing about the hybrid policy too, the amount of money that you put into it up front, if that's how you fund it, usually the death benefit is equal to or more than what you're putting it in. So
That's right.
You or your heirs are going to get the benefit of that money one way or the other, in most cases, not every case.
And just to throw in another nugget, a good hybrid policy will also have a surrender value. So it may not be, and most likely, if you have a return of premium rider on there, it can be equivalent to what you've put in. But most of the time it'll be less than, but it'll still be a majority of what you put in. So let's say, as a lot of people know, life happens, changes, things just happen in life, and something comes up and you just need to get rid of the policy. It's like you're able to at least get a majority of what you've put in back out. And again, that it helps eliminate that use it or lose it risk with the traditional side.
So Matt, if anybody's interested in doing a long-term care traditional, or let's stick with a hybrid because we're big fans of the hybrid policy, what's the underwriting like? If I get diagnosed with a problem, can I go today and submit and see if I can get long-term care? How does that work?
Well, it's like any other kind of life insurance, disability. Any pre-existing conditions can exclude you from coverage, but it doesn't necessarily mean that you will be declined. You can sometimes ask for an exclusion, right? So if you've had a recent event, but you still really want the policy and you're okay with them excluding that from them having to pay out benefits, sometimes that's an option. So they'll just put an exclusion in there. Most of the time it's more or less, though, approved or not. So like any other insurance, though, is what I was going to say is the earlier you can get it, the better. Now, with long-term care, it's not like life insurance. It's not like you want to rush out at 25 and buy a hybrid long-term care policy. But when you get to that, 45, 50, 55, no predetermined age, but that's when you want to start having the conversation, because you're young, you're healthy, and you can lock these types of policies in place. If you're in really good shape and you feel comfortable waiting longer, that's actually ideal. But you're running the risk of, well, if something happens to you medically, you may not be able to get it in the future. So
by age 55, you should really have a hard discussion about this, because the chance of you needing nursing home care before age 55 is really small, but the number of people needing it after age 60 goes up exponentially. So you definitely want to do it before age 60.
And that's a great point. The flip side of that is insurance is not about having it when you need it.
Mm-hmm.
It's about getting it when you can get it. And so long-term care insurance it's not waiting till as close as you can wait until you need it. You're offloading risk, right? Well, every day that goes by, there's a risk something happens to you medically, God forbid, that would keep you from getting it. So it's finding that sweet spot of getting it while you're still healthy and younger, but not getting it so early that it's just kind of a waste or too early.
Well, speaking of sweet spot, David, okay, how much do I need to get? How much long-term care policy do I need?
So you'd start by looking at what the average cost of nursing home care is in your state. In the state of Arkansas, where we are, for example, about $6,000 a month in today's dollars for nursing home care. But then you have to assume about a 5% rate of inflation, let's say, for that care. So you do the math out and figure out, what that might cost 10, 20 years in the future when you might need it, and use that as a guideline for what the daily benefit would be. So divide whatever that cost is by 30 days for the month, and that should give you a guideline for how much daily benefit you might want to think about purchasing to make sure that you're covered. Or now that might be a really large number, though. That's the problem with that. So the alternative is, maybe take 50% of it or 60% of that or whatever, accepting some of the risk on your end to keep those premiums more in check with what you can, what you feel like you can afford. But that's the way you would start, though, is start with figuring out what's the average nursing home care. Use a rule of thumb of about a 5% inflation rate to figure out what that future care is going to cost, and then use that to determine what your daily benefit should be. We've got all those calculators here in the office that we can help you with. We can do all that math for you, but that's how you would go about doing it.
Yeah, just to reiterate that, if you don't want to do all that math that David talked about, he was an Air Force Academy graduate. He can do all that in his head. If you just rather somebody else do it, just come in here. We've got a very nice tool that help you figure out exactly what you might and might not need. Okay, Matt, so I'll buy my policy. Are there any tax advantages to it?
not to bind the policy immediately. There's some tax benefits of how the benefits are paid out on the back end, right? They can be and should be and can be tax free in terms of the benefit payout, and so but not any huge tax benefits that I'm aware of. Now, CPA, I'm not disclosure. I'm not a CPA, so maybe someone's aware of some upfront benefits, but not anything that I'm aware of.
Now, if you're listening to this and you're in either Washington or Oregon, they've got a new law there that you have to have long-term care insurance. It's a requirement, and you have to opt out of it. And there's a whole big deal about it, and there's a bunch of podcasts out there about that, the pros and cons against it. So if you're living up there, you really want to pay attention to what your local laws are. But as far as tax advantages, well, Matt, one could be with these hybrid policies, you can actually purchase that with some tax-deferred money, some IRA money.
Yeah, there is one carrier out there. They actually have a patent on this particular product. It's a company that we do business with. But you can fund this with qualified funds like Mike mentioned. So if you have an IRA that would make more sense to use that to fund this policy up front, then you can do that. So, not any necessarily special tax benefits, but a benefit to being able to use those funds versus having to come up with the cash out of pocket.
Okay, so now I've got the policy. So we know inflation is going rampant now. Are there any kind of inflation protections to it?
It can be, yeah. There's typical rider options on a lot of policies. You can add an inflation rider on there. So a lot of the policies that we'll set up will have that on there.
So you can, but it costs more is what you're saying.
Sure.
Okay, Matt, there's one more question here we've got about partnership policies. What in the world is that with long-term care?
Yeah, so like 15 or 20 years ago, the federal government and state governments kind of got together and set up this partnership plan that really tried to incentivize people to get long-term care insurance. So what it is it's an Medicaid asset disregard amount. So let's say you go out and buy a $200,000 policy, meaning it will pay out $200,000 worth of benefits. Well, if you get to the point and you need to go through Medicaid qualification or Medicaid eligibility, that process, they will, if you had that $200,000 of private insurance, they will add that on top of the normal amount of assets that you're able to keep and still qualify for Medicaid. And so it's a really cool, good, valuable benefit. The problem with it is almost all of the partnership policies are traditional policies and are tied to that side of the business, and that side of the business is the one that's kind of imploded over the last few years and has gotten very expensive. And again, it's not that it doesn't make sense for anybody, it's gotten harder to make sense for a lot of people. So it's not all long-term care policies qualify. I think they might change that in the future to more hybrid, hopefully, because they should want people to buy these new policies. They just haven't caught up to it yet. But that's if you hear of partnership policy, it's not any type of special policy. It just means your specific policy qualifies for the partnership program, so you get that additional asset disregard with Medicaid.
So Medicaid basically gives you credit for having a long-term care policy, and if you run through it all, then you don't have to spend your other assets all the way down before Medicaid kicks in.
Yep, exactly. It's an asset preservation tool like we talked about at the beginning.
All right, folks, that's it for today's podcast. We have Erica doing the editing. We have Matt Hager doing the producing here today. So Matt is our new marketing director. So welcome, Matt. So thank you both for doing the podcast. Erica, can you tell folks how they can submit a question?
Yeah, you can submit those questions on our website under the podcast tab, or you can email them to podcast@mach-1financial.com, and you'll want to be sure to do that for our book giveaway this week.
Thank you, Erica. All right, folks, here's your thought of the day. Planning is bringing the future into the present so that you can do something about it now. Planning is bringing the future into the present so you can do something about it now. You don't want to wait to get long-term care when you need it. As Matt said, you need to be planning for it now. All right, folks, that's it for today. We appreciate you listening to the podcast, and we look forward to you joining us next time on the Mach 1 Market Moment.
Mach 1 Financial Group, Inc., Mach 1, is an SEC-registered investment advisor located in Bentonville, Arkansas. Mach 1 may only transact business in those states in which it maintains a notice filing or qualifies for an exemption or exclusion from registration requirements. SEC registration does not constitute an endorsement of the firm by the Commission, nor does it indicate that the advisor has attained a particular skill level or ability. Past performance is not a guarantee of future results. All investment strategies have the potential for profit or loss. The information presented is the sole opinion of the speaker and is not meant to be investment advice. Mach 1 does not provide tax or legal advice. You should speak with your tax or legal advisor regarding your specific situation. For full disclosures, please visit www.mach-1financial.com/disclosures.